Hi everyone, my name is Armine Bazikyan and I'm a wills and trusts attorney here in Los Angeles. This month I wanted to talk to you about a concept called step up in basis. If you've heard of it or seen articles mention it, it's a very important concept within the estate planning world, and it can, if utilized correctly and implemented correctly, it can help save your beneficiaries a lot of money in taxes. So let's jump in. I want to tell you what it is exactly and how it'll benefit your loved ones. So before we step into discussing the step up in basis, I want to talk to you a little bit about capital gains taxes. So as you may or may not be aware, when you have an asset and it appreciates in value, meaning it goes up in value, and you go to sell it, the IRS will make you pay a capital gains tax, which means you're going to pay a tax on the difference between the price you bought it for and what you sold it for. So if you bought some stock at $100,000 and you sold it at $500,000, you've incurred a gain of $400,000. You've benefited by having $400,000. So they want you to pay taxes on that $400,000. And so this capital gains tax obviously applies to different types of assets like property, stocks, things of that nature. So that's the capital gains tax, right? And so a step up in basis allows your beneficiaries to save on this capital gains tax. So let's do it through a hypothetical, because that's always the best way of illustrating how a concept works. So the step up in basis is actually the inherited value of an asset. So it's whatever price the asset is at the time of somebody's death. That's the definition of a step up in basis. And it's used to calculate how much capital gains tax is owed if that asset is sold. So let's say David owns a piece of property, and David is going to give it to his son Sam. And Sam ends up inheriting that piece of property. David dies, Sam gets the property. At the time that David purchased that property, let's say in the 70s, it was worth $100,000. And at the time of his death in 2018, it was worth, let's say, $1 million. So Sam inherits a property that's worth $1 million. And what ends up happening is, because the property has gone up in value, Sam is actually stepped up. He receives the property at the stepped up value, meaning at the $1 million value. So once he inherits that asset, the IRS, for all intents and purposes, will consider the value of that property to be what it was at the time of David's death, at the date of death value. And because the property has gone up in value, the IRS will say the property has stepped up in its basis. It went from $100,000 to $1 million. Okay? And so what essentially will end up happening is, if Sam holds on to the property, great. If he turns around, let's say in 2019, and he sells it, and at that time the property has gone up just a little bit by, let's say, $100,000, he's basically going to have a gain of only $100,000, because the IRS is going to ask him, hey, how much did you sell this property for? And he's going to say $1.1 million. That was the sales price in escrow. And then they're going to ask him, well, how much did you buy this property for? And Sam's going to say, well, you know, my dad David bought it for $100,000 in the 70s, but he died and I actually inherited this property. He didn't gift it to me. I inherited it, let's say through a trust. And at the time he died and I inherited it, it was worth $1 million. So technically, I've only gained $100,000 in this equation. So that means David only has to pay capital gains tax on that very tiny amount, that $100,000, okay? If it was a different scenario, if he didn't inherit the property, but for some reason his dad had placed him on the deed, let's say right when he bought it in the 70s or whatnot, then David would have had a hefty capital gains tax bill to pay. He would not be stepped up to the date of death value because he would have been considered an owner. So without getting into the complexities of it, the takeaway from this video is that if an asset, if something is inherited, let's just say through a trust, if something is inherited, the IRS will consider the value of that asset to be whatever it was worth at the person's date of death, the person who it's coming from. So dad, mom, brother, sister, whoever it is. So that's going to be the basis, okay? So any future sale of that property, will only be able to deduct the basis from the future sales price. So hopefully the capital gain will be very small in that scenario. And this is pretty much the reason why a lot of people wait until one spouse passes away before they decide to sell a property, because they could take advantage of some of these IRS rules and the step up in basis. Now keep in mind that there's also a step down in basis. So if you purchased a property for a very, very high rate and it went down in value, there's going to be a step down in basis, which can actually negatively impact the person who inherited the asset. So it kind of works both ways. But the takeaway from this is that it's always better to inherit a property because of this step up in basis rule. And it's always the preferred method of transferring something to someone you love versus just giving it to them. It's always better to leave it to them at death versus just giving it to them while you're alive. And it's a great advantage for spouses as well. But I want to note that for spouses, it has to be very particular how title of this asset is held. So not all spouses can take full advantage of the step up in basis. It depends on how that actual asset was titled and how the paperwork shows their ownership interest to be. So be very, very careful about how you transfer assets that you own with your spouse, whether it's your husband or wife, into a trust, because that's going to dictate how you can later take advantage of this step up in basis when one of you is gone. So it's very important to put a proper plan in place, a proper estate plan in place, but to put it in place with the person who actually knows about these rules and laws and can actually take advantage of it. So a lot of times when we put together an estate plan for a couple, we actually have these IRS codes in mind when we're actually talking with you, and we're actually looking at it from the back end and saying, okay, if one of them dies, we want to take advantage of the step up. So how are we going to arrange the estate plan today to be able to utilize and have it benefit us 30 years, 40 years, 50 years from now? So we always look at it from the hindsight, or at least I do as an attorney. We want to make sure that not only will the plan work today, but in the future, it takes advantage of every tax break that we could take advantage of for you and your spouse and your children. And that includes capital gains tax, property tax, a myriad of taxes that we consider when we're overall planning your estate. So feel free to reach out to us if you have any questions. We provide free consultations, so if you'd like us to review an existing estate plan that you have in place to make sure that it was done correctly, we'd be happy to do that. Give our office a call. If you want to put an estate plan in place and you want to discuss this topic a little bit more in detail, feel free to reach out to us. I'd be happy to sit down with you and discuss it in detail. Have a good one. Bye.